Imagine a single Tuesday morning that erased more wealth in a few hours than most nations produced in a decade. Grown men in tailored suits are screaming on a trading floor, watching numbers vanish into nothing. Fortunes built over 40 years are gone before lunch. By nightfall, at least 11 men connected to the market are dead, some by their own hand, thrown from the very windows of the buildings where their fortunes were made. This is not a movie. This actually happened on October 29th, 1929, a date history now simply calls Black Tuesday. But here's what almost nobody tells you. The crash itself lasted only a few days. What it broke lasted for generations. And in many ways, it built the entire financial world you live inside right now. Whether you realize it or not, the banks that hold your paycheck, the government insurance protecting your savings, the stock market apps on your phone, the very idea that the government should step in when the economy collapses. All of it exists because of what happened in the autumn of 1929. This is the story of the crash that didn't just end an era, it rewired the entire relationship between money, government, and ordinary people forever. Welcome to Economy Rewind History. This is how 1 Week on Wall Street quietly redesigned the modern world. To understand how devastating the crash truly was, you first have to understand the fantasy that came before it. The 1920s in America were called the Roaring Twenties for a reason. World War I had ended. Industry was booming. Radios and automobiles were flooding into ordinary households for the first time, and Wall Street had transformed from a niche financial district into something closer to a national religion. Stock prices didn't just rise during this decade, they seemed to defy gravity entirely, climbing higher almost every single year, regardless of whether the underlying companies were actually growing their profits to match. Ordinary Americans began pouring their life savings into the market. Taxi drivers, shoeshine boys, school teachers, people who had never owned a single share of stock in their lives. They were convinced that prices could only go in one direction. And here is the part that should sound eerily familiar, especially if you've ever watched a modern financial bubble form. Much of this buying wasn't even being done with real money. It was being done on something called margin. Margin allowed an investor to buy a stock by putting down as little as 10% of its actual price. The rest was borrowed from a broker. This meant that for every real dollar an investor had, they could control $10 of stock. And as long as prices kept climbing, everyone looked like a genius. Banks, brokers, and everyday citizens had constructed an economy that functioned almost entirely on confidence, on the shared belief that tomorrow would always be better than today. Confidence, it turns out, is an extremely fragile foundation, especially when you build an entire financial system on top of it. By the summer of 1929, cracks were already forming beneath the surface, but they were invisible to almost everyone celebrating the boom. Industrial production had actually begun slowing down. Agricultural prices had been depressed for years. American farmers were already drowning in debt long before Wall Street noticed any trouble. Consumer spending was also starting to weaken, and consumer spending was the actual engine supposed to justify those soaring stock prices. But stock prices kept climbing anyway. They were disconnected almost entirely from the real economy underneath them, floating higher purely on speculation, borrowed money, and blind optimism. Economists at the time who raised warnings were mocked and dismissed. There were a few who saw the danger, but they were drowned out by bankers and politicians, people who insisted America had entered a permanent new era of prosperity, an era where old economic rules simply no longer applied. It is one of the most dangerous sentences in financial history, repeated in nearly every major crash since. This time is different. Then, in September and early October of 1929, the market began to wobble. Prices would drop sharply for a day, then recover, then drop again. It was an unsettling rhythm that made seasoned investors nervous, even as most ordinary Americans remained completely unaware anything was wrong. On Thursday, October 24th, the selling turned into a stampede. That day is now remembered as Black Thursday. Nearly 13 million shares changed hands in a single day, an almost unimaginable volume for the technology of that era. Prices were still recorded by hand and transmitted by ticker tape machines. Those machines fell so far behind actual trading that investors sometimes didn't know the true price of their stocks for hours. Panic spread through the crowds gathering outside the New York Stock Exchange on Wall Street. The scene became so alarming that a group of powerful bankers stepped in. They were led by men from institutions like J.P. Morgan and Company. They pooled their own money and publicly bought shares in a coordinated effort to calm the markets. They wanted to prove their confidence. For one single day, it actually worked. The market steadied. Newspapers the next morning declared the crisis over. It was not. On Monday, October 28th, the selling resumed. Worse than before. Any illusion of a rescue evaporated. Then came October 29th, Black Tuesday, the day the entire fantasy collapsed completely. Over 16 million shares were dumped onto the market. Investors were selling at any price just to escape. desperate to convert their paper fortunes into anything resembling real cash. Before the numbers hit zero, the ticker tape fell catastrophically behind actual trading. Some investors didn't learn the true, devastating extent of their losses until well after midnight. Fortunes that had taken decades to build vanished within a matter of hours. Men who had been millionaires at breakfast were financially ruined by dinner. The psychological shock was almost as devastating as the financial one, because an entire generation had been told the same thing again and again by bankers, politicians, and newspapers alike, that this new era of endless prosperity could never end. In 4 brutal trading days, roughly $30 billion in market value was wiped out. Adjusted into today's economy, that would represent trillions of dollars vanishing in less than a week. But here is the crucial detail most people misunderstand about 1929, the detail that explains why this story matters far beyond a bad week for rich investors. The crash itself did not directly cause the Great Depression. It was the trigger, not the disease. What turned a severe stock market crash into a decade-long global catastrophe came afterward. An avalanche of decisions made in the months and years that followed. Decisions rooted in fear, ignorance, and a fundamentally broken banking system. In the early 1930s, thousands of American banks failed one after another. It became a domino effect that today seems almost impossible to believe. At the time, there was no government insurance protecting ordinary people's savings. If your local bank collapsed, your money simply disappeared with it, gone permanently, no matter how hardworking or careful you had been. This triggered something economists call a bank run. Terrified citizens, afraid their own bank might be next, rushed to withdraw every dollar they had, all at once. Ironically, that panic guaranteed the bank would collapse. Because banks never actually keep all depositors' cash sitting in a vault. They lend most of it out. When everyone demands their money back on the same day, even a perfectly healthy bank cannot survive it. Over 9,000 banks failed across the United States during this period. The life savings of millions of ordinary families were destroyed. Families who had never touched a single share of stock in their entire lives. Compounding this catastrophe, the Federal Reserve made a series of disastrous decisions. The institution specifically created to prevent this kind of crisis failed at the worst possible moment. Economists and historians now view many of its actions as catastrophically wrong. Instead of aggressively pumping money into the collapsing banking system, the Federal Reserve allowed the money supply to shrink. It tightened credit at the exact moment the economy desperately needed it, loosened. Meanwhile, the United States government tried to protect struggling American industries. In 1930, it passed the Smoot-Hawley Tariff Act. This law dramatically raised taxes on imported goods. But rather than protecting the American economy, it triggered retaliation from other nations. Countries around the world raised their own tariffs in response. International trade was strangled at precisely the wrong moment. The global economy needed cooperation, not isolation. Unemployment in the United States had sat around 3% before the crash. By 1933, it eventually climbed to roughly 25%. That meant 1 out of every 4 American workers who wanted a job simply could not find one. Breadlines stretched for city blocks. Families lost their homes, they lost their farms, and they lost the futures they had spent years building. Shantytowns made from scrap wood and cardboard sprang up across the country. They were bitterly nicknamed Hoovervilles, named after President Herbert Hoover. His administration was widely blamed for responding too slowly and too cautiously to the unfolding catastrophe. But this suffering was not confined to the United States. The global economy of the 1920s had become deeply interconnected through international loans, trade, and war reparations following World War I. So when the American financial system collapsed, the shockwaves spread across the entire planet. Germany was hit especially hard. It was still crushed under massive reparations, payments from the First World War, and it depended heavily on American loans to keep its own economy functioning. When that support disappeared, Germany plunged into economic devastation. Millions of ordinary Germans became desperate, humiliated, and furious. This economic desperation created exactly the kind of fear and instability extremist political movements thrive on. Historians widely agree that the Great Depression directly fueled the rise of Adolf Hitler and the Nazi Party. Hitler promised struggling citizens economic revival and national pride, at a moment when democratic governments seemed powerless to help them. In other words, a stock market crash on Wall Street helped create far darker consequences. It helped create the economic and political conditions that eventually led the world into the Second World War. This is the terrifying scale we are actually talking about. A financial event is never just a financial event. It ripples outward into politics, into ideology, to the fate of entire nations, sometimes for decades afterward. In the United States, the political response permanently transformed the relationship between government and the economy. In 1933, Franklin Delano Roosevelt took office as president. He inherited a nation in economic ruin and responded with an unprecedented wave of government programs. Collectively, those programs became known as the New Deal. For the first time in American history, the federal government took direct responsibility for managing the economy. It also took responsibility for protecting ordinary citizens from financial catastrophe. The Federal Deposit Insurance Corporation was created during this era. Today, we still know it as the FDIC. It was designed to guarantee that if your bank failed, your deposits would still be protected, up to a certain amount, by the government. This single institution effectively ended the terrifying phenomenon of nationwide bank runs. And it is the reason modern banking crises do not destroy ordinary savings in the same way. Even during the 2008 crisis, ordinary Americans did not lose their personal savings like families did in the early 1930s. The Securities and Exchange Commission was established in 1934. Today, we know it as the SEC. It was created specifically to regulate the stock market and to prevent the reckless speculation, manipulation, and fraud that helped inflate the 1920s bubble. The Glass-Steagall Act forced a formal separation between traditional commercial banks and investment banks. Commercial banks held your checking account. Investment banks gambled on the stock market. The goal was to prevent banks from risking ordinary depositors' money on speculative Wall Street bets. Social Security was created during this same era. For the first time, America had a government safety net for elderly and disabled citizens who could no longer work. Every single one of these institutions came from the crisis. The FDIC insurance protecting your bank account right now, the SEC regulations governing stock trades today, and the basic idea that government has a responsibility to intervene during economic collapse. All of it exists because of what happened on Wall Street in October of 1929. Now let's talk about why this economic history matters so profoundly. Beyond simply being an interesting story from 100 years ago, the 1929 crash fundamentally rewrote the rules of modern capitalism itself. Before 1929, the dominant American economic philosophy was simple. Markets should be left almost entirely alone. Government intervention in the economy was seen as dangerous, even un-American, and free markets were expected to naturally correct themselves over time, without outside help. After 1929, an entirely new economic philosophy took hold. It was largely influenced by the British economist John Maynard Keynes. This view argued that government intervention was not just acceptable during severe downturns. It was absolutely necessary. Necessary to prevent human suffering, and necessary to prevent economic collapse on a massive scale. This intellectual shift remains one of the most consequential legacies of the entire crash, from pure free market ideology to active government management of the economy. It still shapes economic policy debates in Washington today. Nearly a century later, there are genuine timeless lessons buried inside this catastrophe. Lessons that remain relevant to anyone trying to understand money, markets, and human psychology today. The first lesson is that markets can stay disconnected from economic reality for far longer than logic would suggest. They can be inflated purely by collective confidence and borrowed money, right up until the exact moment that confidence shatters completely. The second lesson is that leverage can be extremely dangerous. Borrowing money to amplify your investments works spectacularly well on the way up, but catastrophically on the way down. It can turn ordinary market corrections into complete financial ruin, especially for anyone who borrowed too aggressively. The third lesson is that financial systems are deeply interconnected, often in ways that remain invisible until a crisis exposes them. A banking collapse in one country can trigger political extremism in another country, even an ocean away. The fourth lesson may be the most important one. The absence of a safety net does not just harm irresponsible speculators. It devastates millions of innocent, hard-working people. People who had nothing to do with the reckless decisions that caused the crisis. This is precisely why modern financial regulation exists at all. Not to punish success, but to prevent the specific kind of uncontrolled collapse that destroyed millions of innocent lives in the 1930s. Of course, this story has its own uncomfortable, darker layers, and they deserve honest examination. Many of the same bankers who publicly claimed to be rescuing the market during Black Thursday had another side. Behind closed doors, some were quietly protecting their own personal positions. Subsequent government investigations revealed something deeply disturbing. Some of Wall Street's most trusted and powerful institutions had engaged in reckless speculation, insider dealing, and even outright fraud. Ordinary investors were never warned about the true danger. Richard Whitney led the public rescue effort on the exchange floor during Black Thursday, but he was later revealed to have been embezzling money for years. Eventually, he served time in prison. The regulations created in response to the crash were not gifts handed down out of pure generosity. The SEC, the FDIC, Glass-Steagall. They were forced into existence by public fury, by congressional hearings that exposed shocking corruption, and by genuine fear among lawmakers. Fear that without dramatic reform, the American public might lose faith in capitalism itself. And there's another uncomfortable detail. Some of these same protections were gradually weakened over time, especially the wall separating commercial banking from investment banking under Glass-Steagall. That wall was eventually repealed in 1999. Many economists argue this helped enable the reckless, high-risk behavior behind the 2008 financial crisis. It proved something disturbing. When the lessons of 1929 are forgotten, they tend to repeat themselves, just in new forms. So why does a stock market crash from nearly a century ago still matter in your everyday life? Because every time you deposit a paycheck into a bank account, you are trusting a system built from that disaster. You trust that your money will still be there tomorrow. That trust exists because of protections born directly out of the suffering of 1929. Every time financial news anchors discuss the Federal Reserve raising or lowering interest rates, they are discussing that legacy. It is a direct, evolved response to the catastrophic mistakes made during the Great Depression. Every debate in Washington about how much the government should regulate Wall Street continues the same argument. How large should banks be allowed to grow? How much risk should Wall Street be allowed to take? Could another financial crisis happen again? These questions began in the smoking rubble of the 1929 crash. We like to imagine history as something safely behind us, but the financial world you live inside right now is not separate from that past. The apps on your phone, the insured bank account holding your paycheck, the regulatory agencies quietly watching Wall Street. All of it is the direct living inheritance of one catastrophic week in October, nearly 100 years ago. And perhaps that is the most sobering truth this entire story leaves behind. Financial collapses do not simply destroy wealth, they destroy illusions. The comfortable illusion that prosperity is permanent, that markets are rational, that the good times will continue forever because they always have before. Every generation since 1929 has been warned about speculation, leverage, and blind financial confidence. Yet every few decades, a new generation walks right back toward the same cliff, convinced that this time truly is different. The crash of 1929 did not just end an era of reckless optimism. It quietly built the entire financial safety net you are standing on right now, without even realizing it, every single day of your life. So the next time you check your bank balance without a second thought, remember what that trust cost. That simple, boring act was purchased at an enormous human price, paid in full by an entire generation. A generation that learned, in the most brutal way imaginable, that confidence alone was never enough, not enough to hold an economy together. If this story changed the way you think about money, markets, and the fragile systems protecting your everyday life, subscribe to Economy Rewind History. Because the past never really stays in the past. It just waits patiently for the next generation to forget it.